Good morning, ladies and gentlemen. We start our review of the past week, as always, with the fixed income market in the States. This is a chart of the 5-year note yield, and as we can see, it has done exactly as we thought last Sunday. It has basically hugged the lower Bollinger Band, and we're now opening the Bollinger Bands, and which indicates there is more downside momentum in yield to come over the weeks ahead. We have not yet turned the 200-day moving average, which is still pointed upwards, which basically means that we are going to have whippy price action from the lower Bollinger Band up to the 200, back down to the lower Bollinger Band, until in a couple of weeks' time we'll have turned the 200-day moving average, and then the downside will be open in the autumn. The danger now is to the downside in yields. The same, we think, can be easily seen in the 10-year. Same behavior, even more extreme. It's going to take a few more days or weeks of price action to turn the 200-day moving average, and then open up the downside below the 2.13% yield, which will be critical for further, break of which is going to be critical for further downside in the 10-year note. At the moment, we think the market is just going to trade in a 10 basis point range. We are right at the bottom of the Bollinger Bands, so it is unlikely to accelerate to the downside. It's more likely to back and fill, and then sometime in the next month or so make another move below 213, but that is not going to happen next week, we don't think. The behavior of TLT, which is 20s to 30s, is actually very, very interesting. It is backing and filling, trying to turn this moving average exactly like the 5-year and the 10-year. It is staying within this uptrend channel. We think it might easily come back towards the low 125s, high 124s in the next week or so, before it tries to fill this gap, which is between 130, let's call it, and 127, which was the election gap. If it were to fill the election gap, it would basically have negated all the Trump bullishness, and that will be a very important signal that the market is rethinking the long-term consequences of a Trump victory. Yields in Europe have done exactly what we said they would do. They have come back to the middle of the Bollinger Bands. These are the weeklies on the Schatz, the 2-year, and now are slowly getting into position to move higher. The 5-year note, much the same. It is now within a couple of basis points of the middle of the Bollinger Band. This is going to be a crucial level around minus 20, minus 32 in yield. This should hold it for the next leg higher towards the towards parity, which would be quite a large move. So we are at the moment thinking about putting on positions which are short the European contracts and long the US contracts. Much the same picture is evident in the Bund. The yields are now right at the middle of the Bollinger Bands. There is big support here, and we could see a move back up to the 60 yield 60 basis points yield in the next few weeks ahead. So it seems that the trade is long of US contracts and short of European contracts, indicating that the spread between US and German EU yields is going to come in, which would have even more bearish consequences for the dollar. The dollar itself is doing nothing but consolidating below our 93.63 very important swing point. Every time it tries to go above, it gets slammed back and it just cannot close a week above it. The Bollinger Bands have tightened, indicating uncertainty at this point, but that the next move is also going to be quite large and quite quick. We now favor the downside, certainly down towards this 90 level, which is a trend line which has been holding it for many months. It could certainly happen within the next 2 or 3 weeks. Another, we keep on failing here, but any move back up towards 94, 94.50, we will be sellers for looking for 90 sometime in the next couple of months. On a weekly chart of DX, the dollar index, the same picture is evident. We have support from the 200 week moving average just below, but we are also through time, through this churning between 94 and 93, turning all these moving averages above, which are now going to rapidly be coming down and strengthening the trend, which will finally take the dollar index at least to 88.43, if not lower. We think that is going to be the totality of the move probably for this year, but that is our long-term target, 88.43 sometime within this year, and this will equate with these highs over here. We think that will definitely likely happen by the fourth quarter of this year. Everything we have been telling you so far, weakness in yields in the States compared to Europe, weakness in the US dollar, is a lead-in to what we think is happening at the moment in the US economy. The US consumer seems to be weak. This is a chart of XLY, and you can see that it is breaking a head and shoulders pattern. XLY just cannot sustain these levels, and it is now breaking. It would not be surprising if it churned around these levels for quite a few days before it made a move at least 3 to 4% lower. XLY is a very important factor in our risk on, risk off models. It is unthinkable that if the US consumer is weak and consumer discretionary sector as a whole is strong, that the market can just ignore it and continue making new highs. Very, very unlikely. It presages a period of volatility, of high volatility in US stocks, and is certainly something not to be ignored. And here we have a chart of XLP against XLY, so consumer staples against consumer discretionary. Consumer staples are very stable. Consumer discretionary is beginning to be very weak. We have broken the 50-day, we have broken the 200-day, we have broken out of the channel. Maybe a few days of hesitation here, and then we definitely go to 0.64, which will be a shock to the system, and should lead the overall indexes to another leg lower of a couple of percent. It is very much a risk-off measure, saying something we don't understand is going on, and when we don't understand something but it's happening, that is volatility to respect. When everybody knows what is happening and why the market is going down, like it happened for Korea, a few days ago, that is something that will be retraced. This could easily be something that will not be retraced because liquidity is moving out, real money is moving out of the consumer discretionary sector and finding new homes. Some, because of the way TLT traded last week, which was a mirror image of SPY, we think quite a few people are going out of cyclicals and into fixed income, which again is a early sign of risk off. Another sign of risk off is high beta within the S&P against the S&P itself. People are selling high beta stocks and moving into safer blue chips. That is also evident by the behavior of the Dow against the S&P. People are basically abandoning riskier stocks which have larger moves and going into the safety, relative safety of blue chips, which is again a risk-off measure. This chart has now turned the 200-day moving average. It might do a couple of wiggles, but it looks like the trend for the rest of the year is pretty much set. We have very much all year been breaking the making new lows all year, and we have retraced fully the whole of the Trump rally, which is an early indication that the overall indices at some stage will just give up and a floor is going to open below them, a trapdoor, and they will fall several percentage points from these elevated levels. Credit is telling you much the same story. This is junk HYG against TLT, 20 to 30 year treasuries. The market is very much beginning to break and make a lower low against a lower high. This is risk-off behavior. This is people moving out of high yielding corporate bonds into the safety of treasuries. It might take a little bit longer to turn that 200-day moving average, but when it does, the market is likely to retest these lows, which were last made in the early part of 2016. This is not risk-on behavior. This is a market which, since the beginning of the year, is saying, I don't like the valuations. I think I'm not being compensated for holding higher risk assets, and therefore I won't. And finally, probably the most important spread indicator, which is SPY TLT. We are right on top of the 200-day moving average. We might have more work to do, probably another month or so of sideways before we see if we can break down. If we were to break down, that would be extremely significant. This is the move that we made in on the Trump election. We will then certainly retrace the whole of that move, and we will have had the first significant lower low that we have had since this whole move started in the early part of 2016. So we will be basically giving up on the bull move that started in the January-February 2016, when the lows were made around 1800 in the S&Ps. Well, we're now at 2400. that might indicate to you how much the index could fall. Certainly not to 1800, but it could certainly fall to 2100, 2200 without any difficulty. But there are several charts which are now telling us that this is mainly a US story. This is ACWI, so this is a world index compared to the S&P. These are world, developed market and emerging market equities against the US. As you can see, since the beginning of 2017, it has been making a turn. You can see how far it has fallen. It has been falling for many, many years. And as we've been telling you, the story of this year is move out of the US and move into emerging markets and other developed markets which are far cheaper. This is now beginning to to take on a very bullish look that if we break this 0.27415 level, we will then be in full bull trend, having turned the 50-day and the 200-day moving average, suggesting that world equities are okay. It's the US that has a problem. And look at what has been happening to one of our favorites, EEM, against SPY last week. While we had weakness in the States, we had nothing but steadiness to strength in emerging markets. Emerging markets have now closed the week at a new high relative to the S&P for 2017. We have broken the resistance levels at 0.179, 0.1763, and we are now in a position over the next several weeks to break higher and move to substantially higher levels. We would argue to somewhere around here, 0.22. Well, that is a 5% move at least in emerging markets against the S&P. So another chart which is telling you that this is not particularly equity related in the world, it's US related, which would make sense because if the US consumer is giving up, we are going to have a relative move in the emerging markets. We'll have more strength in emerging markets than we will do in the US because the US is a consumer-based economy. More evidence that we're not going to have a complete debacle in world equities comes from SPY against FEU. FEU being the European markets in dollars, i.e. hedged. It has been doing absolutely nothing for the last couple of months while the US dollar has strengthened so much. It is now beginning to turn over the 200-day moving average, and at some stage over the next 6 months we really wouldn't be surprised if it traded at these levels again. So again, another chart which is saying this is a US problem, it is not a world equity problem. Finally, just to emphasize how much this is a US problem as opposed to a world problem, this is XLY over SPY, so you can see the relative weakness of XLY. And as we all know, if the US consumer turns, then there is something very wrong with the US. This trend line has basically held the relationship all the way from 2011, and it is now breaking. If we try and do you can see how it has broken, it has made a new low, it has turned the 200-day moving average lower, the 50-day moving average is lower. It is basically saying that XLY is weak even against SPY itself. That is quite dramatic. XLY basically is the sector that you have to short against being long of emerging markets, stroke European markets, stroke any other world index. Bearing those spreads in mind, what can we say about SPX itself? What is it likely to do? Well, it has opened up the Bollinger Bands, but it is at the moment oversold and it closed below them. It is likely at some stage to retest at least the 2450 level, if not the 2460 level. So we don't think it's going to break and fall apart, but we think that the selling it will now be the order of the day. Our model, which is based on all these spreads, will give a sell signal for equities and a buy signal for fixed income, i.e. it will move out of equities and into fixed income, certainly over the course of the next 5 to 10 days. The moving averages that give the sell signals are now so close that it's almost inevitable that a sell signal will appear. That model does not try to pick tops. In equities, what it does is tries to pick the asset that one should be invested in because of possibility of volatility in the asset that it does not want to be invested in. So what we are saying is that any kind of rally now back up towards the 2460-70 area is going to be a sell. From now on, we are going to be better sellers on rallies rather than better buyers on dips. We think that as these Bollinger Bands open up from better levels, we will probably go down and test at least this trend line, which comes all the way back from 2016, which at the moment is around the 2380 area. So that's another couple of percentage points on the downside against 1.5 percentage points on the upside. Certainly, while XLY is as weak as it is, we think risk off will persist, and any rally back up to the mid 2400s or higher is going to be sold. This is not something which is this move is not something which is going to exhaust itself in 1 or 2 days. This is now going to take probably weeks to work towards the downside, at least 2380, if not quite substantially lower at some stage. The sideways to downwards churn in S&Ps is supported by the picture in DAX. It is still trading well below the 200-day moving average. It could hold in here very well while the S&P corrects downwards. So this again is another indicator that we will probably have very little weakness in emerging markets, very little weakness in European markets, which have already corrected substantially, which will leave very little overall downside room in the S&Ps. We're talking a relative move. We're talking a relative move of 2, 3, 4%. Therefore, if the DAX holds in, if the stocks hold in, if the emerging markets hold in, the move for the S&Ps cannot be that large. In outright terms, it'll be larger in spread terms, we think, but in outright terms, the move in the S&Ps will not be huge. Our belief that the outright move in S&Ps to the downside is not going to be in the order of more than 4 or 5% is supported by the behavior of volatility. Volatility is being capped by this 1620, 1630 area that we consider as the swing area for markets which are correcting to markets which are now in a bear phase. For the market to be in a bear phase, we would expect volatility at some stage not only to break 1620 but also to break 1950. and settle above. The market, when it's in bear phases, trades between that 1950 area and 30. So until that happens, we will be of the opinion that rips in S&Ps need to be sold, but they need to be sold with a view to buying them back a couple of percentage point lower, not expecting some kind of a bear market, certainly not until volatility closes well above the 1950 level and starts going towards the 30s, like it did here in early 2016 and like it did here in when we had the shocks in 2015. This is very much contained behavior. This is a correction behavior, and we are quite happy to see that volatility agrees with our current analysis of where the S&Ps will be over the course of the next 1 or 2 weeks. All of which brings us to the biases for next week. 5-year, 10-year, we're still looking for more eventual give up in yields. We think that we will churn for the next week or so, probably back and fill, but we're still better buyers on those dips. Bunds and bobbles, on the other hand, have now reached levels where we can probably short them against the US. Commodity indices are doing absolutely nothing. There is no inflation out there. We can forget about it. Yes, well, we have left what we had before. We would not be surprised by 3-4% range for several months. Danger now shifts to the downside, certainly relative to emerging markets and other world indices. NQ, it's already corrected. We're watching for targets in XLK spreads. We are not there yet, therefore we are not sellers of NQ. But the Russell 2000 is the one that has broken down. It is a leading indicator. People are moving out of more risky stocks into safer stocks, and therefore it is a leading indicator that eventually ES and NQ will both break down rather than up. VX curve, again, we're of the opinion that the curve, as things normalize, will just get steeper and steeper. We're better buyers of dips. We think 11% is now unlikely to be breached for quite some time, and that we will be trading between 11% and 16% in volatility for the next couple of weeks. The super cycle is very much active. This is very much what is happening. It is out of expensive US stocks into cheaper EM and EU. We would exclude XLK because there are some companies in the States that only the States has. So what we are doing is we're buying EM on dips, we're selling the US indices, but we hold some core longs in some individual names in high tech in the States because, well, nobody else has them, so it has rarity value. European equities, you know our view. EM, you know our view. And the dollar index, well, it just keeps on closing below 93.60. That is important. The fact that it can't break 93.60 on a closing weekly basis tells us that people are still getting out of the dollar, and we're still looking at some stage after corrections, probably we're still looking for that 89 area to be tested sometime this year. Those are opinions for next week. Thank you very much for listening, and tweet to you on Monday.